Good morning, traders. This is your Forex market commentary brought to you by real ECN. Today's commentary will encompass the Euro-dollar market. The stage has been set for a volatile trading week for the Euro-dollar market as investors anticipate many market-moving risk events from the Eurozone CPI print to the FOMC meeting and US non-farm payroll report. However, it is important to not lose sight of the balance between the risk-on, risk-off sentiment in the marketplace as it can trigger price breakout in the Euro-dollar market. I hope that this commentary will prove to be insightful for our audience in formulating a successful trading strategy if you're trading the Euro-dollar market. First, in line with this discussion, we will touch base on the Euro-dollar market on the technical level. Last week's trading session has proven to be one of the most volatile trading weeks for the Euro-dollar cross, as the Euro resilient has allowed it to consistently struck off risk events and continue its intra-week rally in the mid 1.3800 band. The Euro-dollar market bottomed out at the 1.3810 during last week's Thursday trading session after falling from the 1.3855 top. This marked the beginning of a strong ascending channel as the Euro consistently struck off any intra-day selling pressure on bullish momentum riding on the back of an upbeat German IFO business index. However, this rally was briefly capped as selling pressure mounted on the dovish ECB rhetorical as Mario Draghi expressed his concern over the elevated euro strength can prompt a more aggressive easing policy from the bank. This selling pressure coming to exhaustion and bottomed out at the 1.3790 level, which was later followed by a reversal in the short-term bearish bias, allowing the pair to retrace all of its losses and in the process broke out from the 200-day simple moving average. This reversal is in short-term bearish bias outlook can be attributed to a disappointing U.S. initial jobless claim print. Ever since the Euro-dollar pair broke out from the 200-day simple moving average last Friday trading session, this pair continued to establish higher lows on an ascending channel. However, it is important to note that every advancement has been met with retail traders taking every opportunity to short the single currency. Currently, according to the SSI, which is also known as the Speculative Sentiment Index, net retail traders have been piling onto every euro rally opportunity. There are currently 4 outstanding net euro-dollar short positions taken by retail traders for every 1 long position. And this extreme crowd sentiment can suggest taking a contrarian standpoint which foresees further euro rally in the near term. The critical Fibonacci resistance set at 1.3900 is where the pair need to take out before analysts would advocate a medium to long-term euro bullish bias to fully gain traction. This week is predicted to be highly volatile for the cross. It is packed full of market-moving risk events which will determine the outcome of monetary policy expectation from both the ECB and the Federal Reserve. Analysis of a collection of technical indicators on the hourly interval on the euro-dollar market suggests a temporary bearish market sentiment and recommend long positions on the greenback. The hourly chart established the single currency open today's Sydney trading session inching closer to its short-term Fibonacci support at 1.3835, while the Fibonacci resistance is set at 1.3845. Going into this week's trading session, the euro bullish bias is still maintained, which allowed the euro-dollar cross to continue to trade above the 200-day simple moving average. Therefore, the long-term outlook on the single currency has been upgraded if the trend line continued to hold above the 200-day simple moving average. This trend hold is significant as 200-day simple moving average contain more or less 1 year's worth of trading data and a forecast long-term market sentiment. This bullish long-term outlook on the euro-dollar pair is also shared by its short-term moving average counterpart as the euro-dollar pair opened today's Sydney trading session above the 5, 10, 20 and 30-day simple moving average. Collectively, this is indicative of a buy recommendation on the moving average front. Okay, it is now important to highlight this week's risk events which can influence the euro-dollar pair moving forward. On Monday, we have the US pending home sale month-on-month forecast at 1%. Tuesday, we have the US CB consumer confidence forecast at 83.0. Wednesday is the most highly volatile trading week for the euro-dollar pair because we have the German unemployment chain forecast to contract at 10,000K. Also, we have the Eurozone core CPI year-on-year forecast to expand at 1%, while the Eurozone CPI year-on-year is forecast at 0.8%. If inflation numbers show an upbeat in reading, this would be enough to prompt the ECB to take a standoff approach on the monetary policy standpoint. This is why CPI number play a great significance in ECB rhetorical moving forward. Also over the United States, on Wednesday we have the US ADP, which is the private sector non-farm payroll employment change, expected to add 200K in terms of jobs. Also we have the US GDP quarter-on-quarter forecast to expand at 1.3%. On Wednesday we also have the FOMC statement and FOMC meeting with interest rate expectation to set at 0.25%. This is important because Federal Reserve rhetorical during the FOMC meeting can hint the development of interest rate hike and whether it could materialize by 2015, which is what the market has expected. On Thursday, we have Fed Chairman Yellen speak, and we also have the U.S. initial jobless claim forecast as 320K. Also, we have the ISM manufacturing PMI print forecast at 54.0. Lastly, wrapping up this week, we have Friday German manufacturing PMI forecast at 54.3, while Eurozone manufacturing PMI is forecast at 53.3. Eurozone unemployment rate is forecast at 11.9%. Wrapping up this week would be the U.S. highly anticipated non-farm payroll forecasted to add the economy's forecast to expand and add 205K in terms of job, while unemployment rate is expected to tick lower at 6.6%, down from previous of 6.7%. Touching base on the fundamental front on the euro-dollar market, last week euro-dollar's strong price action is a clear indication that the euro has continued to remain stubbornly strong against the greenback to a point where it prompted ECB to once again voice its discontent on the current level of the single currency. Last week, Mario Draghi reiterated to the market its aggressive easing policy tool it has at its disposal to combat the elevated strength of the euro. In the past trading session, the market often observed the ECB or ECB official attempt to talk down the single currency with the pair. Price action was trading between the 1.3900 to the 1.400 levels. In the case that the euro-dollar pair can break above the 1.400 level on the fundamental level, this is where the market expects the ECB to back the dovish rhetorical with a more aggressive easing policy. Thus, the ECB breaking out from the 1.400 psychological level would be marked with many resistance. During last Thursday trading session, the market did react violently with a sell-off followed by a retracement of all of its losses as investors began to realize that most of the ECB threat were empty, lacking strong conviction and full backing of observable policy-changing actions. However, this week is packed for market-moving risk events that can swing the currency in either direction, especially surrounding the release of Eurozone CPI year-on-year number, which will highlight the deflationary concern that the ECB holds. Eurozone CPI play an important role in encouraging the ECB to back its dovish rhetorical with the more concrete actions. It is important to understand the relationship between the euro-dollar pair and risk-on, risk-off sentiment in the marketplace. The single currency is often dubbed as highly correlated to risk appetite, and the greenback is often known as safe haven currency that benefit greatly during risk aversion. Therefore, paying close attention to the direction of risk appetite in the marketplace can help gauge the direction of the greenback moving forward. This week, highly volatile market-moving report that can influence risk sentiment in the marketplace include the FOMC meeting, US GDP number, as well as non-farm payroll print. This can help investors build the expectation on the Federal Reserve as it was interest rate hike. According to the VIX, which is a measure of fear in the marketplace, the level of volatility is currently leveling off. This is a clear indication that the market perceived that the prevailing theme continued to be risk-on. However, monitoring the development of the conflict between Russia and Ukraine can help investors predict the trigger of risk aversion. If Russia decides to escalate its tension with a full-scale risk invasion of eastern Ukraine, this can trigger a sell-off in the S&P 500 and spike the VIX index. Touching base on the expectation of this week's FOMC meeting, the market is convinced that the Fed will remain committed to the continuity of its tapering pace by another $10 billion a month. Recent U.S. economic indicator has not provided the market with a strong expectation that the Fed will accelerate its tapering pace. The greenback may continue to remain sluggish against the euro unless the Fed can revise their rhetoric from dovish back to hawkish, or unemployment rate beat expectation by falling below the 6.5% threshold. I want to thank all of our listeners for spending their time with us, and have a successful trading session, everybody.